Navigating early exits versus high beta rotations, a scenario-based option strategy analysis. Abstract. This report provides a scenario-driven analysis of strategic trade-offs when managing positions in broad market ETF call options, e.g. on the S&P 500 index, and considering rotation into higher beta leverage technology ETF calls ahead of a major technology initial public offering, IPO, hype cycle, for example, a prospective SpaceX IPO. The report examines key differences in option characteristics, implied volatility, gamma, theta decay, underlying beta, between broad market index ETF calls and leverage tech ETF calls, and analyzes two strategic scenarios. 1. Exiting broad market call options early to lock in modest gains versus 2. Holding these positions longer aiming for higher premiums before rotating capital into leverage tech calls. The analysis is educational and generalized for market participants, focusing on scenario logic, risk, reward dynamics, opportunity costs, timing considerations, and historical precedents. Two comparable scenarios are contextualized across typical IPO phases, rumor, roadshow, listing, post-IPO, with a comparison of how broad market versus leverage tech exposures have historically responded in those environments. Key option characteristics, broad market index calls versus leveraged tech ETF calls. Understanding the differences in option characteristics is crucial when comparing strategies involving broad market exchange-traded fund, ETF, call options, such as S&P 500 index ETFs, versus calls on leveraged technology sector ETFs, such as a 3x leveraged NASDAQ 100 ETF like TQQQ. 1. Underlying beta and volatility. Broad market index ETFs, e.g. S&P 500 ETFs, have lower volatility and a market beta around 1.0 by construction, as they track diversified indices. In contrast, a 2x or 3x leveraged technology ETF amplifies the daily moves of a tech-heavy index, e.g. a 3x NASDAQ 100 ETF moves roughly 3x the index's return each day. The leveraged tech ETF's realized volatility is significantly higher, often 3x or more compared to broad market ETFs. For example, historical annual volatility for the S&P 500 ETF has been 17%, whereas a 3x NASDAQ 100 product was 62% due to its leverage and tech sector concentration. This means the underlying price swings for leveraged tech ETFs are far larger, which translates into much greater potential gains as well as losses. Trading kite. +1. 2. Implied volatility, 4, of options. Because broad market indices are relatively stable, their implied volatilities tend to be lower. S&P 500 index options generally carry modest 4, since the index's diversification dampens volatility. Leveraged tech ETFs, by contrast, have higher 4. The same short-dated, out-of-the-money, OTM, call on a high-beta leveraged tech ETF will trade at a substantially richer premium than an equivalent broad market index call, reflecting the higher anticipated volatility and risk. The higher the volatility, the fatter the premium. Thus, one pays more upfront for options on a volatile tech fund than on a stable broad market fund. AlphaX Capital. 3. Gamma, delta sensitivity to underlying moves. Gamma measures how quickly an option's delta, sensitivity to underlying price, changes when the underlying moves. Broad market index calls typically have moderate gamma, since their underlying moves are smaller and more predictable. Leveraged tech ETF calls can exhibit higher gamma because the underlying can move sharply in a short time. In other words, a small favorable move in a high volatility underlying can dramatically increase the call's delta and value. This property means that if the anticipated tech rally materializes, leveraged tech calls can very quickly transition from slightly profitable to deeply in the money, yielding outsized gains. However, the same high gamma also implies that if the underlying moves against the call, or fails to move up as anticipated, the option's delta can collapse quickly, exacerbating losses. 4. Theta, time decay. Short-term call options lose value over time, all else equal, due to theta, the rate of time decay. Broad market ETF calls generally have lower theta in absolute terms because their premiums are smaller, with lower implied volatility. There's less extrinsic time value at stake, meaning a smaller daily decay. Meanwhile, calls on high-volatility leveraged tech ETFs have higher theta as their rich premiums erode faster with time. For a high-4, short-duration option, time decay can be steep. A 30-day call might lose 0.05% of its notional value per day just to decay. If underlying volatility is extremely high, theta can exceed this, making holding such calls a race against the clock unless a strong move occurs quickly. Thus, taking a leveraged tech call position too early, long before the anticipated catalyst, can be costly if volatility does not materialize, because the option's value can bleed away much faster than a comparable broad market call. AlphaX Capital. Summary. In essence, broad market index calls provide a more stable, low volatility exposure with modest potential gains and slower decay, whereas leveraged tech ETF calls offer a high-risk, high-reward profile, with drastically amplified moves on both the upside and downside, but also heavier time decay and greater sensitivity to timing. These differences in option Greeks and underlying behavior underlie the strategic considerations of when to exit one exposure and rotate into another. Strategic choices: exiting broad market calls versus rotating into leveraged tech calls. With a pending major technology IPO on the horizon, an investor holding broad market index call options must decide if and when to shift focus to higher beta tech plays to maximize potential upside from the expected hype. We outline two contrasting scenarios to explore the timing and payoff trade-offs. Scenario 1. Early exit and early tech rotation. This approach entails selling the broad market ETF calls relatively early, after a modest gain, to free up capital for entry into high beta tech ETF calls well ahead of the IPO's peak hype. This strategy prioritizes early positioning to capture any early run-up in technology stocks as market excitement builds. The investor locks in a sure profit on the broad market call position, reducing risk of giving back gains, and shifts into leveraged tech exposure to fully participate in the anticipated tech rally. Opportunity. By rotating early, the investor maximizes the time in the high upside position, enabling them to potentially capture the entirety of the IPO-driven tech upswing from its early stages. Large tech IPOs often increase investors' risk appetite and boost technology sectors even before listing day. If hype begins in earnest, NASDAQ and tech-focused ETFs can rally strongly in advance, delivering big returns to leveraged tech calls, which can move 3-5 times more than broad indices on a given catalyst due to higher beta. An early rotation ensures exposure during this run-up. In effect, leveraged tech ETF calls can gain value much faster than broad market calls if the catalyst hits, thanks to their higher delta and gamma sensitivity and the underlying's amplified reaction to tech euphoria. Yahoo! +1. Trading Kite. Risks and trade-offs. Exiting the broad market position prematurely bears the opportunity cost of potentially foregoing further gains in the broad market call if the market continues rising. For instance, broad-based indices might still benefit from improving sentiment or macro factors before the IPO, providing additional gains that an early exit would miss. Meanwhile, entering high-volatility tech calls too far ahead of the catalyst exposes the position to prolonged time decay and volatility risk. If the anticipated IPO hype is delayed or if market conditions turn choppy, the leveraged tech calls could rapidly lose value due to high theta and volatility swings, as the underlying ETF might suffer volatility drag and underperform in sideways markets. In summary, Scenario 1 is a higher risk, higher reward path, banking on imminent tech momentum while giving up additional broad market upside. AlphaX Capital. Scenario 2. Extended hold and delayed tech rotation. This approach has the investor hold the broad market ETF calls longer, aiming to capture more broad market upside potential, assuming the index's positive trend continues, and only rotate into leveraged tech calls closer to the IPO event. This strategy prioritizes maximizing value from the current low volatility position and deferring the switch into high beta exposure until nearer the catalyst. Opportunity. By staying in broad market calls longer, the investor can allow a broad index rally to run its course, potentially boosting the call's premium further. Broad equity indices often require large sustained moves, e.g., 1 to 2% upward days in the S&P 500, to significantly reprice low-delta OTM options. Such moves could plausibly occur in a bullish macro environment leading up to a major IPO. Delaying rotation also ensures that when the investor does enter leveraged tech calls, the time to expiration can be shorter and closer to the anticipated hype, thereby reducing exposure to extended time decay. This approach mitigates the risk of being too early if the tech rally doesn't start until closer to the IPO date. The investor avoids holding a decaying high-volatility position with no catalyst. Risks and trade-offs. The main risk in waiting is missing the initial phase of tech sector upside if the hype cycle starts sooner than anticipated. If the market begins to price in the IPO's significance, for example, during the early rumor or roadshow phase, technology stocks could rally earlier, and a delayed rotation might mean entering the high beta trade at a worse price or with less time to profit. Additionally, broad market index calls might not appreciate dramatically without a broad catalyst if the overall market drifts or stalls while tech begins to move. The investor could face diminishing gains in the broad call and lose out on the tech rally's early gains. Finally, if the IPO's presumed positive impact fails to materialize, say the listing gets postponed or macro conditions deteriorate in the interim, the investor holding longer might see both the initial and subsequent opportunities evaporate. Comparative highlights. The optimal strategy depends on timing. If the IPO's hype cycle is imminent, capturing an early tech rally via leveraged calls may yield far greater rewards than continued broad ETF exposure, given the steeper moves in tech and higher gamma kickers. Conversely, if the IPO is far in the future or its impact is uncertain, maintaining lower volatility positions longer can preserve value and avoid premature theta bleed in high-4 options. Ultimately, neither approach is categorically better. They represent different risk-reward trade-offs suited to different market scenarios and investor preferences. AlphaX Capital. Market dynamics around major tech IPOs, historical patterns, and sentiment effects. When a renowned technology company goes public, the event often drives market-wide attention and speculation. While each IPO is unique, history offers some common patterns in how markets respond before, during, and after these high-profile listings. Below, we outline typical phases of an IPO and their potential impact on broad versus tech-focused market indices. Key takeaway: large technology IPOs can have outsized but transitional impacts on market sentiment. They often boost technology-focused indices and risk assets into the listing, but may not have a permanent effect on broad benchmarks unless the company enters those indices later. Scenario planning for an IPO hype should consider multiple outcomes, from a tide that lifts all boats if the debut exceeds expectations, to a potential ripple of caution if the event disappoints. Exchange listings, index inclusion, and market sentiment. Exchange choice and index implications. Major technology companies usually choose the Nasdaq exchange for their IPOs, given Nasdaq's tech orientation. For example, news reports indicate that SpaceX is targeting a Nasdaq listing for its anticipated IPO in 2026. Many tech giants, e.g. Google, Facebook, Microsoft, followed this path, whereas some high-profile exceptions, like Alibaba in 2014, listed on the NYSE. The exchange selection affects index inclusion. The Nasdaq 100 index, tracked by QQQ, only includes stocks listed on the Nasdaq exchange, so a Nasdaq listing opens the door for rapid inclusion in those tech-heavy indices. In fact, Nasdaq introduced fast entry rules in 2026 to allow newly listed large-cap companies quicker entry into the Nasdaq 100 index. By contrast, S&P 500 and Dow Jones Industrial Average inclusion is not immediate. Historically, the S&P 500 requires at least 6 to 12 months of trading and a record of profitability for consecutive profitable quarters for a company to be eligible. This means a blockbuster tech IPO will not be part of the S&P 500 or Dow at the moment it lists, regardless of size. Yahoo! +1. Faster Capital. Yahoo! +1. Investing Live. Sentiment versus mechanical flows. Lack of initial index inclusion does not preclude broad market impact via sentiment. Even if a newly public tech company is not in the S&P 500, its successful IPO can increase investor confidence in the market, particularly if it represents a major innovation or growth push. Investor enthusiasm and risk-on sentiment can lead to broader buying across equities and index futures, giving a temporary lift to broad indices and raising implied volatilities in general. On the other hand, if the IPO fails to meet expectations, e.g., pricing too high or trading poorly, it may sour sentiment across the market and even halt other companies' IPO plans. In short, the influence of a high-profile tech IPO extends beyond any one index membership. It can shape risk-taking behavior across the market through psychological and liquidity channels. Morningstar. Case study: phased market reactions and strategy outcomes. To illustrate how broad versus leveraged tech exposures might respond through an IPO hype timeline, consider the phase-based scenario of a hypothetical large tech IPO, similar in magnitude to SpaceX, and how each strategy could play out. Phase broad market call exposure, e.g. S&P 500 ETF calls, leveraged tech call exposure, e.g. 3 times NASDAQ ETF calls. Pre-hype, rumors, little direct impact. Underlying broad index moves mainly on macro factors, so modest gains if any. Low volatility means calls gain slowly, low delta, minimal gamma effect, time decay is mild. Faster capital. Tech sentiment begins to stir if speculation arises. Underlying leveraged ETF might tick up if sector rallies slightly, calls see minor for uptick. However, if hype is still distant, high time decay could erode call value without significant underlying move. Hype building roadshow. Broad index may climb modestly if overall risk appetite improves, providing incremental call premium gains. Still low gamma. Potential safe value accrual. Tech sector often outperforms as IPO excitement grows. Leveraged tech ETF can rally strongly in this phase. Calls benefit from rising underlying and increasing for. High gamma can amplify gains if momentum continues. However, calls remain sensitive to any delay or setback, could lose value quickly if hype falters. IPO week and debut IPO listing itself does not directly change broad index composition, so no mechanical impact on S&P 500 or Dow. Investing Live. The broad market may get a small sentiment boost if the IPO is well received, but reaction is limited, e.g., S&P might move fractions of a percent. Calls might hold value or see minor gains if volatility spikes broadly. High volatility and large swings likely. Leveraged tech ETF surges strongly on positive sentiment, potentially far outpacing broad index moves. Trading kite. A successful debut can spike tech ETF values, and thus call prices, significantly in the short term. Conversely, any IPO disappointment can create an abrupt sector pullback. Leveraged calls could lose value rapidly if tech sentiment flips. Post-IPO settling broad index returns to normal drivers, earnings, macro. Gains from previous broad calls are largely realized by now. New broad market positions might be less directly tied to the IPO. If the IPO company eventually qualifies for S&P 500 inclusion, often after demonstrating sustained profits and seasoning, months down the line, it could later cause index fund buying. Investing Live. +1. Tech ETF volatility gradually normalizes. If the new stock's post-IPO trajectory is positive, tech calls may continue to appreciate or can be rolled to longer maturities. If the stock's price falls after the initial hype, common in the months after many IPOs, tech-heavy positions will feel the decline. Investors may exit or hedge. Leveraged products amplify both post-IPO upside and downside, so risk management is critical in this phase. This comparative table underscores that broad versus leveraged tech exposures respond very differently during an IPO's life cycle. Broad market calls are steadier, with limited direct impact from the IPO, except a general sentiment bleed-through. Leveraged tech calls are far more reactive, flourishing in a well-timed, successful hype scenario but vulnerable if the hype disappoints or the timing is misjudged. Conclusion: balancing risk, reward, and timing. The decision to take profits early on lower volatility broad market calls versus holding longer and then rotating into high beta tech calls ahead of a major IPO hype hinges on trade-offs between risk management and potential reward. Broad market calls, lower volatility. These options serve as a comparatively conservative exposure. With lower implied volatility and smaller underlying moves, they provide slower, steadier gains, and time decay is less punishing. This makes them somewhat forgiving if the market moves slowly or the catalyst is delayed. However, their upside is inherently limited. Even a major bullish event in the tech sector might only nudge broad indices moderately. AlphaX Capital. Leverage tech calls. High beta. These represent an aggressive, event-driven play. They can generate outsized returns in a short time frame if the tech rally materializes, due to high gamma and the underlying's magnified movements. Yet they also carry substantially higher risk, large daily swings, 3 times the index, faster time decay, and the possibility of a full premium loss if the anticipated outcome doesn't occur quickly. These are typically short-term instruments reliant on imminent volatility. Trading kite. Strategic timing. Early versus delayed rotation. Scenario analysis suggests no one-size-fits-all answer. An early rotation to high beta calls can deliver greater profits if the IPO-linked rally starts soon, capturing the bulk of the hype-driven moves. But if timing is off, for instance, if the IPO is delayed or the initial excitement fizzles, early entrants may suffer losses due to theta decay and volatility reversals. Conversely, waiting longer in broad market calls conserves capital and may extract extra value if the broad market continues upwards, at the cost of potentially entering the high beta play later when some of the tech rally is already underway. Historical precedent. Past mega IPOs, e.g., Alibaba 2014, Facebook 2012, Uber 2019, show that investor psychology plays a huge role. Positive hype cycles typically start building weeks before the IPO, lifting tech sector valuations and sometimes inspiring spillover rallies in related stocks or sectors. Yet the momentum often peaks around the IPO date, after which a period of consolidation or correction may follow as reality catches up. Facebook stock, for example, dropped in the months after its IPO despite enormous pre-IPO hype. A cautionary tale on overshooting expectations. These events underscore the importance of risk management and scenario planning for traders. The path of least regret often depends on one's market outlook and time horizon for the given catalyst. Morningstar. Educational note. This scenario-based analysis aims to illustrate trade-offs, not to provide financial advice. Outcomes for any individual investor will vary. A balanced approach might involve partial scaling, e.g. selling a portion of broad market calls early, securing profits, while still holding some exposure, then gradually increasing tech-focused positions as confidence in the timing of the IPO rally grows. Whatever the approach, prudent risk management and flexibility are key. Major tech IPOs can indeed be the tide that lifts all boats under favorable conditions, but strategic timing and understanding the instrument's characteristics are essential to navigating these waves.